please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Let's move on. The Sobha developer stock has lost more than 30% this year. So what's weighing on the real estate companies are higher interest rates, accounting changes and the liquidity issues at some of the lenders. To talk more about these developments, we're now joined by C Sharma, the Vice Chairman and MD of Sobha Developers. Good morning, Mr. Sharma. And thanks so much for sparing the time and talking to CNBC-TV18. NBFC companies and pure play mortgage lenders have more than a 50% exposure to the developer market loans. And these companies are now facing tighter liquidity conditions. Do you see that impacting the business of real estate companies?
I won't think so. Basically speaking, at this point of time, what we are seeing on the ground is that the real estate is back to some kind of a normalcy where the new product launches, new project launches and the new sales, they are improving on a quarter-on-quarter basis. As far as the funding is concerned, both to the customers as well as to the developers, they have got multiple options. The cost of funding part, definitely we do agree that it has started going up. But looking at the overall market scenario, even now also you find that NBFC lending to the real estate companies around 12% or so, and the banks lending to the real estate companies below 10% or so. And that kind of more or less bandwidth should continue despite whatever we are seeing at the market at this point of time.
Okay. Good morning, Mr. Sharma, but I just want to reiterate that was my question as well. If for the quarter ahead, considering that housing finance companies and NBFCs are struggling to raise from the market for the last 2-3 weeks, especially the last 1 week, do you foresee that in the next quarter there could be problems, both for developers and for retail home buyers?
See, I have understood your question. As far as the retail buyers are concerned, maybe the cost of funds may go up. But at the same time, when we look at the way the public sector banks and some of the private sector banks, they are trying to take advantage of this kind of a scenario by participating, by actively contributing to our marketing campaign. I believe that the retailers will be least impacted. That is the big picture. As far as the developers are concerned, even when we are talking about this kind of problem which has got escalated in last week or so, the guys who were having problems and who were otherwise not getting money from the banking system, they had gone, most of them, to the NBFCs. And for the NBFCs, if the volumes and if the coverage is getting affected, those kind of opportunities will come to the stronger players with greater velocity. And that way, we believe that we may get more deals at better terms going forward as NBFC starts applying pressure on the real estate developers to see that either they pay up the loan or they give up their projects to the stronger players.
Okay. So you don't fear
in the coming quarters.
Okay. So you don't fear sales slowing down for Sobha developers because of the twin impact of higher interest rates and housing finance companies, which may have to slow down in terms of their lending?
As far as we are concerned, and I can talk about from the sector perspective also, I do agree that the interest cost may go little bit. But if it is there around 9% or so, looking at the overall package, I don't think the volumes per se should come down. Rather, with the kind of launches, affordable housing and certain benefits, the momentum should continue. The problem lies with the developers fraternity who got funding from the NBFC, and that in any case was visible. Hopefully, it will start resolved with those kind of projects coming to now the better players.
What kind of volumes do you expect to finish FY19 with?
See, we grew last year more than 20%, right, in the square footage in the value terms.
Yeah.
We have not given the guidance, but we believe that the kind of performance what we have achieved in the last financial year, this year also we should be doing from a growth perspective better than what we achieved last year.
Okay. Not on realizations perspective?
In the realization also, the new projects, whatever we are launching, we are getting the better price.
Okay.
As far as the old ongoing projects are concerned, we do find that it is difficult to increase the prices, but per se not an issue. As far as the margins are concerned, we still feel that the increase in the margins, the way we are showing at a EBITDA level, that kind of a momentum should continue even going forward.
Okay. Finally, the subvention scheme that the government started for middle income groups, can you just give us an update how many houses have come up, and have you seen an improvement in the amount of money released by the government? Is there a momentum?
Definitely there is a momentum as far as this interest subvention scheme is concerned. Sobha has just got an approval, right, for almost 1,800 units in North Bangalore, which should be launched next month, which will be fully compliant with that affordable housing scheme. And we do believe that that should help us in not getting that volume growth also, in pushing the subvention scheme as well.
Just one final question. So do you continue to maintain your guidance of 9 million square feet of new launches in the coming 3-4 quarters?
Yes, definitely. We should be doing better than that. We remain bullish, we remain confident that structurally the market is going into the hands of better players, organized players, and we are clearly seeing the improvement in the volumes.
Okay. All right, sir. That's good to hear on that optimistic note. Thank you very much, Mr. Sharma, for joining us and giving us your perspective. Now joined by Rasesh Shah, Chairman and CEO of Edelweiss Financial Services. Good morning, Rasesh. Thank you very much for joining us. Well, you understand all these markets well. Does the debt market, I mean, is it possible to raise money in the debt market now? And will that become possible only if the regulator does something in terms of a line of credit?
See, I think there are 3-4 factors we should keep in mind. I don't think that debt markets are closed forever, but we always have a liquidity crunch around the last week of September and last week of March, because I think end of half year and end of the fiscal year are always liquidity tight period, where a lot of the corporates and banks who invest into liquid funds in the mutual funds, they withdraw money. So there is always a commercial paper unwinding that goes on. Obviously, that has got exaggerated because of the recent events which are there. I do think the commercial paper market will be there, but will be much smaller. If you look at currently, the total commercial paper market for NBFCs is about 2.5 lakh crore. I think it will stabilize at about 1.5 lakh crores or so. If you look at a lot of the steady state liquid fund data and all. So I think it will be there, but not to the same scale it was there. Also, I think most of the people use commercial paper, like we use commercial paper, but only with a backup of undrawn lines, because every quarter, every half year, you redeem your commercial paper and use the bank lines, and you use a combination of these two, and that will also continue, I guess.
Okay, and yesterday I was asking people exactly this. After all, commercial paper is drawn from your credit lines, carved out of your credit lines. But there were a few debt market traders saying that banks are unwilling to lend. And that could be because they are competing with the housing finance companies, at least, also with NBFCs in the same space. Are you noticing this hesitation on the part of banks?
No, actually, in the last 3-4 years, I think banks, the best part of the bank's portfolio has been their exposure to NBFCs. In fact, there is almost zero NPAs on banks giving loans to NBFCs across the board. Also, remember, at a structural level, and this is a very important part that a lot of people have not appreciated, when banks give a loan to NBFC, let us say 1,000 crore loan, banks will keep aside, say, 100 crores of equity for that. Now that NBFC, when they give 1,000 crore loan to their housing finance customers, they also keep another 130 to 140 crores of equity aside. So at a systemic level, 1,000 crore credit is actually supported by 230 to 240 crores of equity, partly by bank and partly by NBFC. So banks giving to NBFC and NBFCs eventually giving loans to customers, there is a lot more equity safety that is there, and that's why we have never seen problem on the bank portfolio of NBFCs.
No, I'm not saying safety. I'm just saying the dealers said that banks are hesitating to give those lines in the last 1 week.
I think a large part of this is the current upheaval that is going on because information, there are a lot of rumors and all. But also remember that last 5 years, NBFCs were growing at 25 to 30% a year and banks were growing at 8% a year. Now we are seeing bank credit growth has gone up from 8 to about 13, 14. I expect NBFC's credit growth will stabilize at about, say, about between 15 to 18%. So what you are saying is very true. I think the NBFC growth will get calibrated after 5 years of 25, 30% growth. I think the next few years will be a 18% kind of growth for NBFCs. And what the equity markets have done is actually quickly recalibrated the growth hypothesis around NBFCs, which I think is not incorrect.
Okay. So, sir, what you're saying is that the credit growth of NBFCs will moderate from 25 to 30% that we enjoyed in the last 5 years to 15 to 18% going ahead.
Yes.
But the asset quality of NBFCs will remain intact. Okay.
Yeah, we are not seeing asset quality issues because, as you know, home loans and other collateral-backed loans and all, we have not seen, even in the last 5 years where Indian economy has gone through stressful time, we had GST, we had demonetization. If you look at the NPA levels of all NBFCs, they have not actually deteriorated. Plus, in the last 3 years, most NBFCs have also raised more equity. So I don't think there is an asset side issue. There is a liability crunch that will happen, which will slow down growth. But along with slowing down growth, I think the margins will improve and the asset quality will also improve going forward.
Okay. Why would you say margins will improve? Even on the last 1 week, we have actually seen yields go up. I don't know how many NBFCs can push off, 1 percentage point in terms of their asset price.
In fact, if you see today, like you take a simple product like loan against shares. A loan against shares, which a lot of brokerage and wealth managers and all do, the interest rates have already gone up by 100 to 150 basis points on the LAS books. And we heard in the last couple of days, a lot of NBFCs on the personal loans and SME loans have already hiked yields by about 100 basis points. So I think there is a market demand that is there, and whenever there is a supply side constraint, a large part of the portfolio will absorb the higher yield. So my expectation is that most of the NBFCs will be able to pass on the extra cost very easily. So at least our hypothesis is that the NIM competition is not a bigger risk. I think the growth slowdown is a bigger factor.
Okay. So what about you yourself, Rasesh? How will Edelweiss's growth be impacted in the second half?
I think it will be in the same way. We will all hold a lot more cash. We will all, scale back some of the books because you will be more careful on liquidity and the assumptions you make about liquidity. Like we hold about 10% of a balance sheet as liquidity cushion. We have decided we will try to hold about 15% of the balance sheet as liquidity cushion. So people will hold more liquidity. People will not disburse in a hurry, and that will automatically moderate the growth down. But as I said, I don't see the pricing issues will be there. We have clearly guided our investors that don't expect the same growth rates for the next year.
Okay. Has the industry made any representation to the RBI to ease the situation, see a separate line of credit?
No, as far as I know, I don't think the industry should go to RBI for every little problem. This is, as I said, if you had commercial paper which are backed with undrawn bank lines, you should be drawing bank lines and repaying your commercial paper. That is how the market should work. Your cost may be higher, but that is what anyway we were doing at the end of every quarter. So that is part and parcel of that. And if your commercial paper market shrinks, then your growth will also shrink.
Okay. See, the crux of the epicenter of the problem is IL&FS. We've got some statements of LIC chairman saying we will try to ensure it doesn't collapse. He was clearly saying try. And we have a newspaper report saying Oryx is putting money. You know the experience of restructuring loans and how long banks take. What is your sense of this, the end game of IL&FS?
I think 4 or 5 points. As you very correctly said, I think IL&FS has shaken the confidence on the entire financial sector, largely because we all underestimate it. But when a AAA rated paper gets downgraded to to junk, it is a big shock to the system. The confidence has to get shaken up. So I think that started off the whole thing, because it's not very, in any economy in the world, AAA companies don't get downgraded in one single step. So I think the first was that part of it. The other is our mutual fund industry is geared to take interest rate risk, but not geared to take credit risk. If you find out the credit research provided by brokers, the credit research provided that is carried out by mutual fund, it is very, very low. So all the mutual funds, everybody carries out interest rate risk. Everybody listens to you, figures out what is happening to repo and all, but nobody does credit research in India. And I think this should highlight the fact that we need to not outsource credit research to credit rating agencies, but everybody needs to conduct credit research. And the third will be that I think IL&FS is larger. The larger problem is a liquidity problem, not so much solvency problem. Yes, they were short of equity because they were geared a lot more than they should have been geared, but that was known to everybody, including the investors. And from what I hear, the investors have been talking about putting money or doing an IPO for the last 1 year. So I think equity need of IL&FS of say 5 to 10,000 crores was evident all along. But that equity shortage has been coupled with a liquidity mismatch, which is also another 8-10,000 crores. So if the investors provide liquidity and some equity, I think the problem can be handled.
Okay, one final question, Mr. Shah. IL&FS assets are on the block. You have a leadership position in the stressed asset space. Have you evaluated the assets?
And how quickly will they sell?
No, I think a lot of the IL&FS assets are not at IL&FS level. They are at the subsidiary level. The the road assets they have, and
SPV
others
assets.
They already have some term sheet signed. We have an infra yield fund in which we also buy this asset. So I'm sure they would have evaluated. I've not been in the loop on that, but we're always looking to buy operating infra yield assets. So in that we would have evaluated. But IL&FS is selling assets at the road level and at the power SPV level.
Okay. Well, a very quick question. I'm completely out of time. I'm borrowing from the next show. New rules needed in terms of caps for mutual fund investments sectorally. New rules needed for rating agencies, you think?
Yes, I think we need that. I think we also need rules for ALM management of NBFCs. If NBFCs are using commercial paper, they should have undrawn bank lines as part of the rules. All this needs to be articulated and put down. I think we have to learn from this that commercial paper market can be uncertain and people have to be prepared for that. So I agree with you. I think we need some new rules on this.
Okay.